would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California. Member of the National Association of Realtors. But please, don't hold that against me. Thank you so much for taking the time to join me in today's show. Hopefully the time you spend will not be wasted. You'll walk away with far more in good mental thought nuggets than you spent in time. We've got a few interesting topics to cover today. We'll probably creep on a time pretty soon here when it makes sense for me to give you an update on what's going on with my own personal real estate efforts. For those of you who are new to the show, I'm in the process of getting my home ready for sale. My goal was to have it going on the market right around now, because statistically doing it this month is you tend to get the best bang for the buck. That's probably not going to happen. There were some delays. I have a family member who's a contractor who I was kind of waiting for to get some work done. That isn't panning out as well as I'd hoped. Went ahead and hired some other folks to do the kitchen work. The kitchen is more or less done. I'm going to do the tiling, the backsplash on that one, and then the painting, and that will pretty much be completed. There's a door that needs to be replaced, and painting, and there's a lot of general painting that needs to go on. So that's been really what I've been working on. Now, for those of you who use Zillow, because it's, all information is good to get, then you can decide how valuable it is. I've been getting the usual updates on my zip code from Zillow, and Zillow is telling me that things have moved into a buyer's market. I'm saying the same thing now about Gilroy, which I find interesting. I'm not 100% sure I'm on board with that. The buyers I'm dealing with are still facing challenges in terms of having multiple offers on properties. The homes that are in the best position to get sold are obviously still going pretty quickly. But on the flip side, as I've mentioned in previous shows, I am seeing more homes available on the marketplace, and I am seeing them tend to stay on the market for longer. So we'll see how that plays out for me. My goal was to try to sell right at the peak, as close as I could call it, and we'll see if that theory ends up being okay. We've talked about trends that I think are concerning about the market moving forward. So this was really a exercise in me sort of putting my money where my mouth is, and we'll see how that all pans out. I'll either do okay or I'll be very embarrassed that I took my own advice. All right, I think we'll jump in. Well, first, before we get started, of course, the usual is to let you all know how to get in contact with me. The best way to do that is through the website at www.therebelbroker.com. Once you're there, you can just click on Contacts in the menu bar. Send along any ideas, suggestions, observations, or questions that you might have. I'd be happy to reply. And of course, while you're there, you're going to want to get your name entered into the drawing for our $50 Amazon gift card. You can do that by clicking the big red button at the top of the page titled Take the Survey to Support the Show. Give the same email address both times you're asked. Make sure it's an email address that you'll actually receive email at, because that's how I let you know you've won if you win the drawing. You'll also be asked to answer a few demographic questions. Once you've completed those tasks, you will be entered into the drawing for the $50 Amazon gift card. And we do this once a month. We've given away $400 about, if I'm remembering correctly, $450. And we try to do it at the beginning of each month. So we've already done it for May. We'll be doing it again in June. And good luck to you who haven't yet entered but plan to before the date arrives for the next drawing. And congratulations to those of you who have already won that $50 Amazon gift card. Okay, we've talked a lot about debt. We talked in the last show, or one of the shows last week, about choices that people are making in terms of how they handle their debt. And it was an interesting chart. I hope some of you got a chance to check it out. If not, you can head on over to therebelbroker.com, take a look at it. You can also go to my Pinterest page and see some of the data relating to what things they choose to pay and not pay. And amazingly enough, the thing they tend to stop paying right there at the top, not the top, there's this, I think it's close second to the top of the list, was their mortgage. They tend to pay off things that are shorter term type loans, but I also think it's the fact that they've learned from experience, from reading news articles, headlines, seeing things kind of happen when the last downturn occurred, that folks tend to get to stay in their home for a very long time when they stop making their housing payment, their mortgage payment. So there's really this feeling, I think, that folks can coast for a while without having to worry about being kicked out of their home. Now, whenever we will hit a milestone in debt, I think it's an important thing to note. Now, this comes from Zero Hedge. U.S. household debt surpasses the 2008 high, and it hits record $12.7 trillion. We've kind of talked about how this is broken up in terms of what kind of debt it is. Some of it is not very good debt. It's auto debt, credit card debt, HELOCs, those types of things. And then hit this in the first quarter of 2017, surpassing its $12.68 trillion peak reached during the recession in 2008, according to the New York Fed's latest quarterly report on household debt. Some quick breakdowns. Total household indebtedness stood at $12.73 trillion as of March 31st, 2017. This increase puts overall household debt $50 billion above its previous peak set in the third quarter of 2008 and 14.1% above the trough set in the second quarter of 2013. Mortgage balances. The largest component of household debt reached $8.63 trillion as of March 31st, a $147 billion uptick from the fourth quarter of 2016. So just across one quarter. This isn't comparing it to the same time last year, but the honest truth, this is one of those rare occasions when comparing it to the exact same time last year might be interesting to get a feeling of overall growth. But this is just a very short period of time that I think is very indicative, with a $147 billion increase just from the fourth quarter of last year. Next, balances on home equity lines of credit fell slightly in the first quarter, down $17 billion to $456 billion. That's actually good news. Non-housing debt kind of was mixed, an increase of $10 billion on auto loans, $34 billion in student loans, and a $15 billion drop in credit card balances. Now, that is actually the line that jumped out at me. Why? Well, because this dovetails in perfectly with the data we were talking about last week. What do people pay first? The trends that we're seeing, the areas where we're seeing debt being serviced first, fall in with the model of you do the credit card first, right? So next, the question is because we're starting to see an increase in these other types of debt, which are the ones that we've already seen people tend to ignore, and they tend to hit these credit card balances, these short-term loans faster. Is that an indicator that folks are getting into that mindset of feeling overburdened with debt and taking the actions that someone does when they have more debt than they feel like they can handle? Now, as an overall chunk of the debt, mortgage is by and large the highest. When we look at the chart, we see a big ramp up. This chart goes back to 2003, and we see it sort of peaking for the first time in 2006, in the first quarter of 2006. So just before things start to go nuts, then things go nuts, and the mortgage indebtedness tends to go down, and we've been slowly growing ever since. But what's interesting is the stuff that has really grown since then. And again, this falls into this theory of what do we worry about in terms of overall debt. The amount of student loan debt is ridiculously high compared to that same period. It looks like 3 times greater than in 2006. The other thing that's quite a bit more substantial than before, auto loans. So again, another one of those things we've paid attention to here that is concerning because of how much that debt has grown. Now, there was one other thing mentioned in this article that I thought was interesting when they were talking specifically about housing debt, because I think they may be missing something here. Now, the very first point they make is, quote, mortgage balances increased again while originations declined and median credit scores of borrowers for new mortgages increased, reflecting tightening underwriting. There was $491 billion in newly originated mortgages this quarter. And I'm not sure that's true. I'm not sure that reflects tightening underwriting. Originations declining. I'm not sure that you can make a direct link that, but median credit scores of borrowers for new mortgages increasing, I don't think represents a tightening underwriting. I think it represents what we've talked about, that the way credit scores are being calculated is being manipulated in ways to artificially increase it. So I think what you see is folks who would normally be scoring lower on their credit scores end up scoring higher on their credit scores. We've talked about this a lot over the last 4 or 5 months. We've explored the various ways that they've made things that shouldn't be on your credit score get on your credit score, and in a positive way. So I think that trend isn't necessarily that things are tightening in underwriting. And my practical experience with buyers on the street is not that it's tough to get these loans. It's simply not happening in my marketplace. But I think this is a sign instead that we should expect to see average increases in credit scores because we're manipulating the way the credit scores are calculated so that they end up being higher. Now, next, I wanted to talk a little bit about some interesting news that's coming out relating to home sizes. And I'm not real sure that what we're seeing here is the trend that the headlines want to sell us. So don't go away. We're going to discuss that next, right after this. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We're covering some interesting stuff today. We did a little bit on the debt stuff before the break, and I throw those out there because these are all just sort of updates on the ongoing narrative, really, as it relates to debt. I'm really concerned about that. I think that is potentially something that's going to have the biggest impact on the future of real estate, not just from the standpoint of whether you're an investor who's trying to decide whether or not you're going to do a flip or a rent, and whether or not you can get the rent you need to get, or whether or not you can flip it for what you need to flip it for, but also from the standpoint of sellers and trying to anticipate what potentially is going to happen in the marketplace that could affect the price of your home, and for buyers, trying to anticipate what's going to happen with prices so you know what you can afford. So I would strongly suggest you keep an eye on that too, particularly in your local marketplace, and see how these things are playing out. And I'd love to hear from the rest of you in other parts of the country. What's going on with your marketplace? Are you starting to see things now transition away from sellers over to buyers? It's definitely an interesting marketplace where I am. And the trend that Zillow is starting to consider to be the case is that we're seeing buyers markets creeping up in the areas south of the Silicon Valley area. And my data only kind of indicates that from an anecdotal standpoint, but I'd love to hear what's going on in other big areas across the country, some big metro areas. Okay, so the next story I wanted to cover is about new home sizes. The trend is towards smaller homes. The sub quote here is, or the sub headline is, more Americans would prefer buying smaller homes. No, and this is one of those things. I think if you think about this for a minute, it makes sense, right? Now, for whatever reason, the media is really pushing this kind of talk, whether it's the average size of a home is going down, or it's tiny homes that you can fit, on the back of a truck or whatever. This seems to be the big push. There are so many different avenues where they're talking about smaller living. It's absolutely a trend that tends to happen when you're doing apartment living and those types of things. But when you're actually buying a home, I find that when my buyers are shopping for a home, the factor that influences whether or not they buy a bigger or larger home does not really have a whole lot to do with preference. Now, I'll occasionally get someone who wants to put a maximum on the square footage that they'll consider, but those folks are rare. I can't actually even remember the last time I had a client who wanted to put a maximum value in the square footage of a home that they would buy. However, I do find that my buyers put a minimum square footage. Some of them do it right when they first talk to me. I absolutely don't want to buy a house that's less than 1,500 square foot. Don't show me anything with less than 1,500 square feet, period, end of story. I have buyers I'm working with right now who, after viewing a bunch of different homes and me noticing a correlation between stuff they like and the square footage, we had a discussion about that. And sure enough, they decided they don't want to look at anything that's under 1,400 square feet. Okay. Now we're going to talk about some general numbers here that they're throwing around in this article from Housing Wire. But they phrase this like this is people suddenly thinking this is what I want. And it really doesn't have anything to do with want. It has to do with afford. And the reason I'm mentioning this is because it may have a huge influence on what gets built down the road. The numbers I'm seeing here don't indicate to me that it's affecting it down at the square footage minimums we've been talking about so far. But it'll be an interesting trend. And if it moves far enough that direction, and there's another story that I think kind of interestingly fits in with this. If you're a renter who's offering something that gives folks that square footage, gives them something that is less available in the new construction world, and you're in that area where those types of construction is going on, it could really bolster the value of your rental. So let's go ahead and talk about this, because this is actually something that I think is likely to happen in the area north of me in parts of San Jose. Just without question, it is happening in terms of single family residential square footage. But the other story, the story we're going to end on today, is also interesting, and it's super attractive to property builders and owners for reasons we'll discuss, but also for those of you who might have rentals in areas where this is happening of the more conventional type. It could make your property much more attractive by comparison. All right. Now, the data that we get here is that median single-family square floor area decreased to 2,389 square feet. And that's according to first quarter data from the Census Quarterly Starts and Completions by Purpose and Design and a National Association of Home Builders analysis. Now, for a lot of folks, you're going to be thinking, well, geez, that's a decent-sized home, but that's down from 2,440 square feet last quarter and 2,465 square feet from the same time last year. So in general, we're seeing a downward trend. Now, we're still at historically a relatively high number. In fact, we kind of peaked in 2013, 2014, and we've been on the decline since about 2015 in terms of the size of what's actually getting built now. The average square footage also decreased slightly from 2,652 square feet in the fourth quarter and 2,658 square feet last year to 2,628. Now, the chart that I'm going to share with you, which you can find up on Pinterest. So what we've got is a situation where these things are starting to trend down. We're already at kind of a high point. So if it continues as a trend, an overall trend, it could indicate a shift in your marketplaces in terms of what is available for folks and may represent a advantage for you down the road in terms of what you're offering. My idea is if I'm going to offer property, and we've talked about this on all the various aspects of investing, right? If you're going to have a vacation rental, you should have the appeal of the reason why people go to that area, right? So in Hawaii, an example would be as close to the water as possible, right? If possible, views of the ocean. That's what people go to Hawaii for. If you're doing it in skiing territory, being very close to the slopes, right, is important. Or understanding what's available versus what's not available, understanding what elements of the marketplace are underrepresented. And if you're in one of these areas like north of me, and you happen to have a home that's a 3-bedroom with slightly higher square footage, that makes it a more lucrative investment. It makes it more attractive to people when you show it to them, and it allows you to charge a premium for that. Now, here's an interesting comment that was made in this article right at the end that really kind of jumped out at me. And then the National Association of Home Buyers, according to this, points out that while home sizes trend lower before recessions, the current increase is due to builders bringing much-needed entry-level homes to the market. That kind of jumped out at me a little bit. Did that tickle any hair on the back of your neck? The National Association of Home Buyers points out that while home sizes trend lower before recessions, the current one isn't from that. Don't worry, it's not from that. It's due to builders bringing needed entry-level homes to the market. Well, it seems to me that that's kind of the story every time, right? It's the need of more homes. There's more. You need to get more homes per shot. There's a ton of homes that were built just before the last recession in an area of San Jose where they went for that row house vibe, simply because they could fit so many more homes per acre than in a standard scenario, right? So, and that was because there was a huge demand for those homes. So I'm not sure you can make the statement that this isn't something that you might necessarily want to clue into as something that tends to precede a recession. When these sorts of decisions are made, and I agree, we absolutely need more entry-level homes. So it's absolutely the truth. But it was interesting for them to sort of go out of their way to point out that, but this, while it has in past instances been just before a recession, that's not what's happening this time, without really explaining why that's true. Because in the previous markets, what they follow up with, needing homes that people can afford, is also what fed it last time. So anyway, an interesting comment that I thought might be worth sharing. Now, next from Realtor Mag, it's realtor.org is where this story comes from. And this one is very interesting because it reaches a level of density in terms of how you're handling real estate that I find interesting. For number one, it reminds me of how things were going in the 30s in terms of how people were getting accommodations. And second, it's concerning because it feels like the kind of thing that comes just before something bad. The title of the article is "A Wave of Co-Living Apartments is Coming." It opens up with, and this is a story that also was on the Wall Street Journal. Now, there's a pay gate on the Wall Street Journal, so I wanted to give you this story since there isn't a pay gate on this. Quote, several startups and real estate owners are jumping into the apartment sharing business, where they rent out individual rooms instead of entire apartments. Now, I don't know if we're referring to this in the East Coast sense of an apartment, right? People can own their apartments in New York, or I've heard people who own the place they live refer to it as an apartment. When I hear an apartment, I think of a multiple unit building where no one owns the units other than the owner of the entire building, right? And then if an apartment stops being an apartment, it becomes a condo where each individual apartment becomes a condominium that's sold separately. So I don't know if it's a terminology difference, but judging by this, it doesn't really matter since it's just a question of who the actual owner of the property is. They give the example of a property markets group through its PMGX division started offering the co-living option in one of its Chicago buildings. So these are definitely folks who own a building. The company plans to develop more buildings designed for co-living and expand the offerings to more than 7,000 beds and 3,500 apartments over the next few years. So they're getting into the business of not renting apartments, but renting bedrooms within the apartments. What's interesting is they're doing a lot of marketing of this to millennials. Quote, everyone is trying to wrap their arms around new living concepts for millennials. Ryan Shear, a principal with Property Markets Group, told the Wall Street Journal. The one-room rentals can be cheaper for renters than renting an entire apartment. I would hope so. For example, PMGX tenants pay as low as $1,000 a month to rent a room than the entire apartment. Renting an apartment in Chicago, Miami, or other major cities often costs double that. Quote, if you're 22 years old and you just got your first job out of college, you're looking for the cheapest point of entry in a market. All you want is a room. It'll be interesting to see how far this goes in terms of what developers decide to glom onto. According to this article, developers say co-living apartments will cost more to build than other apartments, however. Each room will have a separate bathroom. Many of the units will also come partially furnished with built-out closets and TVs. The Wall Street Journal reports developers are attracted to the idea that they can charge more for a co-living unit, collecting rent from multiple tenants than if they rented the space to just one tenant. So it really satisfies that need of diversifying, right? You're the property that you own. Even if someone moves out, you're potentially continuing to make more money per month from all your other tenants. So even though you may only have 2 apartments, you may be getting 4 sets of rent from those, say, two, each of them being 2-bedroom, 2-bath setups. Now, this is something super interesting. Now, the only reason I mention that is because I have come across an awful lot of apartment complexes and condo developments in this area of, not my area of Morgan Hill, but San Jose, South San Jose, parts of Central San Jose, East San Jose, where a lot of these condos and apartment buildings are set up exactly like that, where each bedroom has its own dedicated bathroom. Each room is almost sort of a quote-unquote master suite. And I think that's something that could really catch on in some of these areas. And what's also interesting is it introduces a whole new strategy for folks who want to do that buy and hold and rent strategy and diversify it to the next level. I think it would present some interesting management challenges if you're just renting out rooms. What does that look like? What are you doing in terms of marketing, and what is the reliability of that? Are there any additional costs to doing it that way? And I'm just not sure that it would be if you pick the right marketplace. Now, for me, let's say I wanted to dabble in this. My first instinct would be to try to find an apartment or condo setup like this that's near some high-tech companies. Maybe go north and start looking for anything that's not more than, say, a 15-minute drive from the big bubble that is made when you connect Cisco and Apple and IBM and Facebook and Google and all of these big companies, which makes a gigantic area. For those of you who don't know Silicon Valley, starting all the way up at Redwood Shores, which is kind of up the peninsula to San Francisco, going all the way down to Sunnyvale, and even heading down to sort of the southern San Jose area. There's even a couple of high-tech places in Los Gatos. Netflix is down in that direction, for instance. The guys who make the Roku are down in that direction. So if you could be inside of that bubble, and there's an awful lot of space in that bubble, something like this, I think, could actually work really well. And you could definitely target those folks depending on the style of advertising you're doing. So maybe this is a strategy that's worth putting into the mix for you. And I would imagine this would be also something that might work well with students. If you want to create a situation in a college town where you're able to take advantage of this strategy. I think there's a lot of areas where this could potentially be interesting. You could potentially be making more by renting the room than by renting the apartment. I have clients who have done this, not quite in the exact same way, but I had clients a couple of years ago who wanted to buy a 3-bedroom townhome right near Santa Clara University. They purchased it. They ended up renting out 2 rooms for friends of their daughter, and their daughter stayed in it rent-free. But the amount the other folks were paying for their rooms was enough to cover the mortgage on the house. So it's sort of a more industrialized version of that, or a more put it out into the marketplace way of doing that. So, anytime we can add another tool to our potential investment strategy, I think that's a win. I'd want to look into this a little bit more, but I think this could be an excellent way to move forward with an investment, but also a great way to leverage off of things that already exist. I know even when I lived down in Anaheim, California, back in the old college days, that was the apartment I had. We had a 2-bedroom apartment. Each bedroom had its own full bath. And that was just sort of the way it worked. And that whole building could easily be converted into this sort of management investment style. All right. Well, I hope that's been useful for you, folks. It's at least something worth bouncing around in your head to see if you want to move your investment strategies in that direction, or maybe just keep it in the back of your head. Who knows? You may encounter a situation where you realize that this would be perfect for that. Now, I do appreciate you all taking the time to tune into the show. Thanks for listening, and I'll talk to you all next time.